Hi all, I am Sharmila, Head of the Department of Accounting and Finance, Thiruthangal Nadar College. In this video, we will be learning about Indian capital market. In the capital market, we will be covering money market, features of Indian capital market instruments, functions of Indian capital market, debt market, regulation of Indian capital market, SEBI, that is Securities Exchange Board of India, then regulatory bodies in stock exchanges, steps in stock trading and OTCEI. Let's start with the financial system. So what does mean by financial system? It is a structure in an economy so that capital can be mobilized from the surplus sectors and it can be distributed and allocated to the needy sectors. Its financial system facilitates transformation of savings into investment and consumption. It will lead to economic growth of our country. So financial system is a network of financial institutions, financial instruments, financial markets and financial services. Next, let us see what is meant by financial market. Financial market is a place where people trade various financial products such as equities, bonds, derivatives, currencies, commodities, etc. So financial market is further classified into capital market and money market. So capital market is further classified into primary market and secondary market. So money market instruments are call money market, treasury bills market, commercial bills market, commercial paper and certificate of deposits. So let us see the introduction of capital markets. So capital market are the lifeline of an economy that facilitates funding for government, corporations and other institutions. Moreover, capital markets are funding infrastructure for the economy, therefore they may be called as lifeline. Savings and investment are channelized to those in need of funding in capital markets. Investors and savers can include households and institutions, while capital seekers primarily include government, corporations and institutions. So let us see the meaning of capital market. So capital market are the place where securities are exchanged between two parties. So these securities incorporate equities, bonds, preferred shares, derivatives, commodities, etc. Almost all financial instruments are traded in the capital market. Let us understand what is mean by capital market with a small example. So if XYZ company, a new venture, is going to start a new operations. So they need a capital of rupees 500 crores. Hence, they are going to raise the capital through IPO, that is initial public offering. Investors will invest in the XYZ company. So in turn, XYZ company can raise a capital of rupees 500 crores and they have started their operations and also they have started to earn a profit. In turn, investors will get a dividend from the profit and stock appreciation. Further, in future, XYZ company is going to expand their project. So to expand their project, they need an additional capital of rupees 100 crores. So this 100 crores to be raised with the help of FPO, follow-on public offer. So capital market is divided into two, primary market and secondary market. Primary market is otherwise known as new issue market. So in primary market, new securities are issued for the first time. Shares are issued directly to the public through IPO, that is initial public offering. So the second one is the secondary market. It is otherwise known as stock exchange or stock market. In the stock market, where already existing shares are traded between investors. So the next one is the Next type of financial market is the money market. So money market deals with short-term funds whose period of maturity is up to 1 year. This is where companies and governments can meet the short-term borrowing needs. So the various types of money market instruments are call money market, treasury bills market, commercial bills, commercial paper and certificate of deposits. First let us see what is meant by call money market. So it is mainly used by the banks to meet the temporary requirement of cash. It is repayable on demand and its maturity period varies between 1 day to fortnight. So next, second type of money market instrument is treasury bills. In short, it is known as T-bills. It is issued by the RBI on behalf of the government. It is a risk-free investment because they are backed by the government. It is also a secured instrument and are issued for a period of not exceeding 364 days. And the third type of money market instrument is commercial bills. So it is a bill of exchange to raise short-term money. It is generally issued for 90 days. Commercial banks discounts commercial bills to provide credit to customers. And the fourth one is commercial paper. It is an unsecured money market instrument issued in the form of promissory note. So who can issue this commercial paper? So only highly rated corporate companies can issue this commercial paper. So who can invest in this commercial paper? Individuals, banking companies, NRIs, FIIs and corporate bodies. So the duration of the commercial paper ranges between 7 days to 1 year. Mainly it is issued to meet the working capital requirements of the firm. So on the last type of money market instruments or certificate of deposit. So it is issued by commercial banks and financial institutions. Scheduled commercial banks, regional rural banks and small finance bank can issue the certificate of deposits. So all resident Indians can invest in certificate of deposits. The duration for the certificate of deposit ranges between 7 days to 1 year. Let us learn and understand what are the features of Indian capital market. First one is wide range of investment. The Indian capital market offers various financial instruments such as equity shares, preference shares, debentures, bonds, derivatives and mutual funds catering to diverse investment needs. And the second features is two-tier market. Why it is said to be two-tier market? Because it has primary market and secondary market. SEBI regulates the capital market to ensure transparency and to protect the interest of the investors. And the fourth one is liquidity. So what is meant by liquidity? So it is easily encashable. Otherwise, it can be converted into cash easily. So investors can easily buy and sell securities, ensuring liquidity through organized stock exchanges like Bombay Stock Exchange and National Stock Exchange. So then fifth feature is government and corporate participation. Here both the government and private corporations actively participate in the capital market. Next one is supports economic growth. Capital market mobilizes savings and directs them into productive investment, boosting industrial and infrastructural development. So next one is presence of intermediaries. The Indian capital market is supported by intermediaries like stockbrokers, depositories, underwriters, credit rating agencies and merchant bankers. So next let us see the capital market instruments. So capital market instruments is classified into two: ownership securities and creditorship securities. So ownership securities are equity shares, preference shares. Creditorship securities are debentures, bonds. First let us see what are the ownership securities. First one is equity shares. Equity shares is otherwise known as ordinary shares. So equity shareholders have ownership right and they are the owners of the company and they have voting rights in the general meeting or any other important decisions. They share the profits in the form of dividend. Risk is high in investing equities. There is no any maturity date for the equity shares. And the second type is preference shares. Preference shareholders carry a preferential right to payment of dividend during lifetime of the company. They enjoy priorities over equity shares in terms of payment of principal at the time of liquidation of the company. Back. So next capital market instrument is creditorship securities. Creditorship securities or debentures, bonds. So debenture is a debt instrument issued by a company with a promise to pay interest and repay the principal on maturity. Debenture holders are the creditors of the company. And the second one is bonds. It is a fixed income financial instruments. It is issued by corporations and governments to raise funds for financing their capital requirements. Let us learn and understand what are the functions of Indian capital market. First one is mobilization of funds. The capital market attracts savings from individuals, institutions and the government, channelizing them into productive investments. So second functions are facilitating investment and innovation. Capital market supports entrepreneurial activities by providing access to capital for innovative ventures and expansion projects. And the third one is efficient allocation of resources. It ensures that funds are allocated to the most efficient and productive sectors by maximizing their returns. And the fourth function is liquidity provision. So what is meant by liquidity? So it is easily converted into cash. Otherwise it can be easily encashable. So in the capital market, liquidity is more for the investors, enabling them to buy or sell securities at any time through stock exchanges like BSE and NSE. And the next function is encouragement of savings. So capital market offers attractive investment opportunities, encouraging individuals to save and invest rather than consume. So the last function is economic growth. The funds raised in the capital market are utilized for productive purposes, leading to industrial and economic development. Let us see what is meant by debt market. Debt market is a marketplace where buying and selling of debt market financial instruments takes place. These are fixed income securities giving fixed returns to the investors. So who can issue in the debt market? Corporates or companies, municipal corporations, state or central government, local panchayats and local bodies, banks and financial institutions, public sector undertakings. So next let us see the types of debt market. Types of debt market is divided into three. First one is bonds, second one is government securities and the third one is debentures. So let us see what is meant by bonds. A bond is a fixed income instrument where investors lend money to an issuer for a specific period in exchange for periodic interest payments and the return of the principal at maturity. The types of bonds are government bonds. It is issued by the governments. Example, treasury bond, sovereign bonds. And the second one is corporate bonds. It is issued by companies to raise long-term funds. The third one is municipal bonds. It is issued by local governments or municipalities for public projects. Fourth one is convertible bonds. It can be converted into equity shares of the issuer. And the last type of bond is zero coupon bonds. It does not have any periodic interest but are issued at a discount and redeemed at face value. And the second type of debt market is government securities. These are debt instruments issued by the government to finance fiscal deficits and other expenditures. It is a risk-free investment because they are backed by the government. It has a fixed interest payments. In the types of government securities or treasury bills, in short it is known as T-bills. It is a short-term securities with maturities of less than a year. Example, it may be a 91 days, right, or it may be a 182 day, or it may be a 364 days. And the second type is government bonds. Long-term instruments with maturities ranging from 5 to 40 years. And the third one is sovereign gold bonds. It is issued by the government linked to gold prices. And the fourth one is inflation indexed bonds. It provides return adjusted for inflation. And the third type of debt market is debentures. Debentures are unsecured debt instruments issued by companies to raise funds backed only by the creditworthiness of the issuer. It is an unsecured one. It carries a fixed interest payment. The types of debentures are convertible debentures. It can be converted into equity shares after a specific period. The second one is non-convertible debentures. It cannot be converted into equity shares and typically offer high interest rates. The third one is secured debentures. It is backed by specific assets as collateral, reducing risk for investors. Then let us see the difference between shares and debentures. Shares, the type of first one, we will see the type of investment. So shares have ownership rights. Debenture holder does not have ownership rights because it is a debt instrument. In the shares, return may be in the form of dividend and capital gains. In the debentures, return may be in the form of fixed interest payments. Risk is higher for the equity shareholders. Risk is low for the debenture holders. Shareholders have voting rights, but debenture holders does not have any voting rights. So priority in repayment of shares is paid after all the debts. Priority in repayment of debentures is paid before the shareholders. Next, let us see the regulation of Indian capital market. The first one is regulatory framework. So SEBI, that is Securities and Exchange Board of India, they are the primary regulator of the Indian capital market, responsible for protecting the interest of the investors and promoting market development. Then second one is RBI, Reserve Bank of India. They regulates and supervises banks and financial institutions which play a crucial role in the capital market. And the third one is Ministry of Finance. It formulates policies and regulations for the capital market in consultation with SEBI and RBI. And the fourth one is Department of Economic Affairs. They are responsible for capital market related policies and regulations. Next we will see the laws and regulations. So first one is Securities Contract Regulation Act 1956. It regulates the trading of securities in India. Second one is SEBI Act 1992, that is Securities and Exchange Board of India Act 1992. They are the primary regulator of the Indian capital market. The third one is Depositories Act 1996. It regulates the functioning of depositories in India. Then fourth one is Insider Trading Regulations. It prohibits insider trading and regulates the disclosure of price sensitive information. Then we will see who are all the regulatory bodies in the Indian capital market. So first one is NSE, National Stock Exchange. So one of the largest stock exchanges in India, which is regulated by SEBI. And the second one is BSE, Bombay Stock Exchange. It is the oldest stock exchange in India. It is also regulated by SEBI. And the third one is Indian Commodity Exchange. It is also regulated by SEBI. And the fourth one is Credit Rating Information Services of India Limited, CRISIL, a credit rating agency also regulated by SEBI. So next let us say what is SEBI. The Securities and Exchange Board of India is the regulatory authority for the securities and capital markets in India. It was established in 1988 and gained statutory status in 1992 under the SEBI Act 1992. Its primary objective is to ensure the orderly functioning of the securities market and protect the interest of investors. So next we will see the functions of SEBI. So functions of SEBI is categorized into three: regulatory function, developmental function and protective function. So first we will see the regulatory function. SEBI will define the rules and regulations to be followed by the financial entities including intermediaries. So they will levy penalties and fees for contravening rules and orders. And next regulatory function is SEBI will conduct inquiries and audit of stock exchanges. And we will see the developmental functions. SEBI will conduct research for the development of the stock market. SEBI organizes training session for the intermediaries such as brokers, sub-brokers for the market efficiency. Next we will see the protective functions of SEBI. It prohibits insider trading. So it prevents malpractices by checking price rigging. They will give education to the investors, financial education to the investors, and also they will prevent unfair and fraudulent trade practices. And next one is regulatory bodies of stock exchange. There will be 4 key regulatory bodies in stock exchange. So first one is SEBI, second one is RBI, third one is NSE and fourth one is BSE. So first one is SEBI, Securities and Exchange Board of India. It was established in the year 1992. Its headquarters are situated in Mumbai. SEBI is the primary regulatory body responsible for overseeing the securities market in India. It ensures that the stock market operates efficiently with transparency and fairness. SEBI's role include investor protection, fair trade practices and market development. And the second regulatory body in stock exchanges, RBI, Reserve Bank of India. It was established in the year 1935. Its headquarters is situated in Mumbai. It regulates the monetary policy and foreign exchange, which are integral to the stock market's functioning. RBI's role include monetary stability, foreign exchange control and banking regulation. And the third regulatory body of stock exchange is NSE, National Stock Exchange. It was established in the year 1992 and its headquarters is situated in Mumbai. The National Stock Exchange is one of India's leading stock exchanges. It provides a transparent, fully automated trading system with high levels of efficiency and security. NSE's role include market regulation, investor support and risk management. And the fourth regulatory body of stock exchange is BSE, Bombay Stock Exchange. It was established in the year 1875. Its headquarters is situated in Mumbai. The Bombay Stock Exchange is Asia's oldest stock exchange and remains a cornerstone of India's financial market. Like the NSE, the BSE ensures that all companies adhere to listing regulations promoting transparency and investor protection. BSE's role include market regulation, investor support and risk management. Next, let us discuss the trading procedure in the stock exchange. There are 5 steps in stock trading. The first one is selection of a broker, and the second one is opening demat account. The third one is placing the order, and the fourth one is executing the order, and fifth one is settlement. So first we have to selection of a broker. First, we have to select a broker who has been registered under SEBI. So, broker will buy and sell the securities on behalf of the investor. So, after selecting the broker, we have to open a Demat account. Demat account refers to a dematerialization account. Investors hold their shares and securities in electronic format. So, after opening the Demat account, the investor will place the order with the broker. So, order can be placed to the broker either personally or telephonically or through email. After order is placed, so next one is the execution of the order. So, according to the instructions of the investor, the broker places the order. That is, he buys or sells the securities. So, after executing the order, so the last step is the settlement. Settlement can be of two types. The first one is on the spot settlement and the second one is forward settlement. So, on the spot settlement is done immediately. T+2 rolling settlement. That is, it means that any trading taking place on Monday will be settled by Wednesday. So, then forward settlement, it refers to that settlement will take place on some future day. So, let us see the difference between new issue market and secondary market. So, primary market, the capital market where securities are issued for the first time. In the primary market, shares will be issued for the first time through IPO, initial public offering. The secondary market, where already existing shares are traded between investors. The alternative name of primary market is new issue market. The alternative name of secondary market is stock exchange or stock market or after issue market. So, the products traded in the primary market are corporate or government bonds, fresh stocks of companies, notes and bills. The products traded in the secondary market are equity shares, preference shares, bonds, debentures, etc. The intermediaries in the primary market are investment banks and other underwriter firms. The intermediaries in the secondary market are brokers. In the primary market, buying and selling takes place between the issuing company and investors. But in the secondary market, buying and selling takes place among investors and traders without the involvement of the issuing company. So, price of the shares remains fixed in the primary market and price of the shares fluctuates in the secondary market depending upon the changes in supply and demand in the market. So, the beneficiary in the primary market is only issuing company. The beneficiary of the secondary market is the investors. And let us see the OTCE. What is meant by OTCEI? So, OTCEI was incorporated in 1990 under Section 25 of the Companies Act 1956 and is recognized as a stock exchange under Section 4 of the Securities Contract Act 1956. It does not have any central place of exchange and all trading occurs through electronic networks. It is India's first exchange for small and medium companies as well as the first screen-based nationwide stock exchange in India. The objectives of the OTCEI are it assists and guides small companies to raise funds from the capital market in a cost-effective manner. It provides a convenient and an efficient avenue of capital market investments for small investors. It also ensures transparency literacy. So, let us see the difference between stock exchange and OTCEI. So, stock exchange have a centralized marketplace for trading securities, but in the OTC, it does not have any centralized marketplace for trading the securities. It is a decentralized marketplace where securities are traded directly between parties. So, stock exchange is an organized market and OTC is an unorganized market. So, in stock exchange there will be a high transparency because all transactions are publicly disclosed. In the OTC there will be a lower transparency because transactions may not be publicly disclosed. So in stock exchange, brokers trade on the exchange floor or electronically, but in the OTC, direct transactions between buyers and sellers, often with market makers or dealers. In stock exchange, liquidity is high due to large number of buyers and sellers. In the OTC, there is a lower liquidity depending on the security. Market hours is fixed typically during weekdays in the stock exchange. In the OTC, market hours is flexible, that is 24/7 depending on the market. The types of securities traded in the stock exchanges are listed stocks, bonds, ETFs and other securities. The types of securities traded in the OTC are unlisted stocks, bonds, derivatives, foreign currencies, etc.